Hello, my name is Tom Vassallo with MRW Financial Brokerage, and thank you for participating in this webinar on our long-term care planning toolkit for annuity advisors. There's a real opportunity for annuity advisors when it comes to long-term care. Of course, everyone knows we have an aging population. By 2030, all baby boomers will be over age 65, creating an unprecedented need for long-term care. And it is a underserved niche. There are very few advisors that are specializing in long-term care or even talking about long-term care proactively. I get calls all day long from advisors whose clients have brought up long-term care to them, but very few that are talking about it proactively. And there are several reasons for that we'll discuss. There's growing client awareness. It started back with COVID, and as baby boomers have gone through and seen their parents need care, they start realizing how important care is and that they need to plan ahead for it. And I don't know how many of you are familiar with the Washington Long-Term Care Act. But in the year 2020, the state of Washington represented 3% of national long-term care sales. In 2021, the state of Washington accounted for 60% of sales nationwide for long-term care. And that's because they created something called their CARES Act, where they gave $3,000 a month of long-term care coverage to every Washington resident for 12 months, for 1 year. Well, they had to have a way to fund that. And the way they decided to fund that was to have an increased tax, state income tax on payroll. So there was a mad rush for all high net worth individuals to purchase long-term care, because if you owned a long-term care policy, you could opt out of that program and not have to pay that tax. There are currently 18 states discussing this. Four of them here are actively moving forward. Now, nothing's been passed yet. Nothing's been legislated yet, but it is something that's coming. And it's a way, because what happens is if you don't have an act like that, you end up on the Medicaid rolls. So by rolling out an act like that, they're shifting a lot of the cost away from Medicaid over to that CARES Act. But what they've been able to do is also create a new tax to fund it. So it doesn't just fall on Medicaid and burden Medicaid. We've also had a significant product innovation in recent years. The asset-based long-term care plans make all the sense in the world for someone. First of all, if you don't have assets to protect, you probably don't need a long-term care plan. Medicaid is there for you. It's the safety net. If you do have assets to protect and get to the very high net worth individuals, they sometimes decide they want to self-fund rather than pay the old traditional long-term care premium for their life, have substantial rate increases, and if you don't use it, you lose it for long-term care. Well, the new asset-based plans aren't like that. We can repurpose an asset, move it from the left pocket to the right pocket, leverage it for long-term care, and if you don't use it for long-term care, it still goes on to your beneficiaries and your children. So unless you need to consume that asset in retirement to pay your normal living expenses, it's going to pass on. There's no reason not to consider an asset-based long-term care plan. We can do single premium or flexible premium. So in other words, a monthly premium all the way to age 100, or a single premium and a lot of options in between that can coincide with your possible retirement date. For example, a 55-year-old who's in high income earning years right now may want to do a 10 pay so when they retire at 65, they aren't carrying that annual expense into retirement. This gives you substantial opportunity to grow revenue. These are high value premiums, strong commissions in them, and selling opportunities. Long-term care discussions, when neglected by a current financial advisor, gives you the opportunity to create a wedge and move into, their investment management, their annuities, their life insurance. I teach a whole course on the impact of a long-term care loss on a healthy retirement plan. and how if you have someone that you're talking about and they have an advisor currently who put together a long-term care plan and didn't model long-term care, and you take their numbers and then model a long-term care cash flow event, how their retirement plan falls apart and it's something they never addressed with them. That's a wedge that you can use to create between them and their current advisors. And it also creates repeat and referral of business. I can't tell you how many times we have one person purchase the policy or a couple purchase their policy, and all of a sudden we're getting calls from their siblings and their in-laws that want that same type of coverage for themselves. The client's benefits and peace of mind that it receives. First of all, there's tax advantages. The ability to reposition a non-qualified annuity that has substantial gains in it and is subject to the last in, first out taxation, position that into an annuity compliant with the Kent Pension Protection Act. And if you need it for long-term care, it all comes out income tax free rather than passing that deferred tax liability onto your children is tremendous. And also business owners have the ability. I was just on the phone with someone this morning. Clients doing $160,000 single pay long-term care policy, owns a commercial nursery, a C corporation. They're going to deduct $98,000 of that premium this year. Also gives them control and choice. You can use the benefits at home, assisted living, memory care, nursing facilities. You can even, on some of the policies, use the benefits to pay immediate family members to take care of you. And of course, legacy and retirement protection. Families want to avoid that financial strain and preserve that inheritance for their heirs. They also want to preserve a healthy retirement lifestyle for their spouses. What are some of the challenges when it comes to long-term care? This is what's preventing people from planning for long-term care. Clients' misconception and denial. They think Medicare is going to pay for them. They don't understand the difference between Medicare and Medicaid. They think the VA is going to pay. And no one wants to think about planning for long-term care. And if they can find an excuse for it, like my friend had Medicare pay for it, and didn't understand what the friend's situation was and how limited Medicare is as far as a nursing home benefit or any type of home care benefit. They just have that misconception. They have a denial. There's also a terrible history with the traditional long-term care policies that were use it or lose it for long-term care and have had substantial rate increases since the client purchased them. All of the asset-based plans we're talking about today have ironclad guarantees. You're never going to have to worry about a rate increase down the line that's going to jeopardize your relationship with your clients and your primary revenue generating tool. And there's also an emotional disconnect. And what I mean by that is when someone calls or calls an advisor and says, I want to talk about long-term care, I can almost guarantee you they're going through some type of event or just went through some type of event with their family members. And they want to make sure they don't put their children in that same situation. If someone hasn't been through that event, they aren't thinking about long-term care. What does that tell me as specializing in this for 32 years is we do a terrible job presenting the problem to people that haven't been through it that would make them want to then, make the investment of time and money to put together a plan and a solution to fund care if they need it. And that's the whole idea around our long-term care planning toolkit. What are our goals with the long-term care planning toolkit? We want to equip you as the advisor with a simplified, branded resources that remove the complexity of long-term care and help you present asset-based long-term care plans efficiently. We want to accelerate the client's engagement and decision making, and we want to overcome those educational barriers and client misconceptions. And we also want to differentiate you as an advisor in the retirement planning market and the annuity market so you can talk about long-term care and talk about it confidently. So with that in mind, we put together our long-term care planning toolkit, and it is designed to go through a very specific planning process. For advisors that want to work with us on this, we're, your typical brokerage general agency. There's a calendar link down below this video. Click on that calendar, book a time with me right now, so we can start the process moving forward. But we also provide you a training platform that discusses this planning process. So we have certain meetings that you want to do. Number one is the long-term care discovery meeting. I have advisors all the time that say, I have a client interested in long-term care. They called me, can you run some quotes? No, I'm not going to run some quotes. Instead, you have to use our long-term care planning guide, help establish the need and find out what their situation is. Then, once you complete that questionnaire, we'll put together the planning summary and the illustrations and have a second planning meeting. Then that third meeting is where we're going to refine the plan, exactly what monthly benefit, how do you want to fund it, take an application at that time. But there's no money due at the time you apply. So I'll show you how we do the soft close as far as getting the application and getting them in underwriting. And then, of course, once it's issued, it's policy funding and policy delivery. So we have this in a step-by-step process. We have a long-term care training platform where I bring you through videos and show you exactly how to accomplish this with the tools that we provided. Now, all of this material that I'm about to show you in the toolkit, we can brand for you with your contact information, and we'll do it for whatever areas of the country you are working in. Now we're rolling out the 2026 version. So this is the 2025 Long-Term Care Planning Guide. And we have emails and social media posts that you can use to help generate activity. Anyone that raises their hand and downloads that long-term care planning guide is someone you have to pick up the phone and call. And what really sets this long-term care planning guide apart is the 18 videos, just 1 to 3 minute videos that help make that emotional connection and tell the story for long-term care. This also is what I use to navigate that first discovery meeting, is this long-term care planning guide. And it takes you through sort of my long-term care presentation that I've developed over the last 32 years and has proven very successful. The first question you always have to ask a client is, why are we talking today? What's your personal history with long-term care? And if they say, oh, my mom needed my father, my uncle, my aunt, whatever it is, almost everyone's got a story. You need to dig a little bit deeper. How long did they need care? How was it funded? What did it mean? Were the children having to provide care? You need to freshen up the wound and make that long-term care experience real. There are some individuals, however, who have never had that experience. Maybe their parents passed away young. So that's what this first page is about. And it talks about, this is the perfect time to talk to people about long-term care, because they're coming home, they're seeing their parents, they're seeing maybe dad slipping, mom's getting overwhelmed providing care, and this is the time of year claims start. And we have to have, mom needs some help at home. Well, if they haven't been through a long-term care event, everywhere that you see that QR code, and everywhere that you see the your client can either scan it or click on it if you send them the PDF, and it's going to play a 1 to 3 minute video. And what this video is it's talking about, from the mother's point of view, the wife's point of view, what it means when dad starts slipping, mom starts providing care without even knowing it. Family realized mom needs some help. We bring in a home health aide to help out. Now it's gotten to the point that home care isn't reasonable anymore. So we need to either move into independent living together, or dad moves into assisted living or memory care, and then the more end of life nursing home. And then now that dad's gone, who's going to be there for mom? And it tells that emotional story to pull on those emotional heartstrings for people that haven't been through it with their family members. Of course, the next thing is, people probably say, well, it's not going to happen to me. Well, this is the fact. If you make it to age 65 as an individual, there's a 70% chance you're going to need long-term care at some point, a 30% chance you won't. But for a married couple, and let's be real, long-term care is a cash flow event. It's not an asset problem. It's a cash flow event. And it doesn't matter who needs care. If it's the husband or the wife, it's going to have the same cash flow impact on that married couple. And you'll see why I stress so much that it's a cash flow event. But for a married couple over age 65, there's actually a 49% chance they will both need care, a 42% chance that only one spouse will need care and not the other, and only a 9% chance that neither one of them will need care. In other words, there's a 91% chance for a married couple over age 65 that one or both of them will need some form of long-term care. And how can you put together a retirement plan for someone and not model a long-term care risk when there's a 91% chance they're going to experience that cash flow drag? And once again, we have the videos that help communicate that point. The next thing is a lot of people start talking to their children about long-term care, and their daughters especially are step up and say, you know what, Mom, Dad, you took care of me. Don't worry, I'll be there for you. I live here locally, having no idea what that means and what that entails. You know, they're trying to raise their kids, probably have a job and take care of their parents at the same time. This video talks about the crucial role of paid long-term care providers. Yes, I want my children and my eventual grandchildren to be there with me when I need care, but I want them there spending quality time with me. I don't want their last memory to be bathing me, dressing me, and toileting me. I want to hire a paid caregiver for that, and most people will understand that. Then we show them the actual cost of long-term care in their area. Now, this is the only thing that changes when we make the different additions, and it's the cost of care. And we can get as narrow as each metropolitan statistical area. So this is Tampa, St. Pete, Clearwater. Then there's a Bradenton, Sarasota, Inglewood, just south of here. So, you know, we can get fairly narrow. And what this is showing is what the cost of care is. So this long-term care cost in 2025 is $80,230. That's simply the average of someone moving through informal care, home care, assisted living, and nursing home. We don't assume they'll just all go to the high-cost nursing home and spend all of their time there. Many people ask us, what is informal care? Informal care is how much it's costing your daughter to provide care. And they've done studies on this that the average caregiver is having to cut back at work, maybe retire early, maybe start Social Security early, pass up on promotions, retire early. And on average in the Tampa St. Pete area, the average informal caregiver, it's going to cost them $74,000 a year over lifetime income and benefits for every year that they provide care. And then, of course, home health care, assisted living home, and nursing home is pretty self-explanatory. We use this to really point out that long-term care is a cash flow problem. And there are costs and consequences in self-funding and converting assets to cash flow. Then we talk about what we want to accomplish with long-term care planning. What we want to do is create leverage, get $1 to do the work of $2, $3, or $10. So we want to create that long-term care leverage. The next question I'm going to ask someone, and this is a very important point, and it's very important to do it this way. By this time, I've probably, through the conversation, determined who is making the financial decisions, but maybe not. But I'm going to ask the question. I'm going to say, if you, and I'm not going to point to the husband or wife, I'm going to say, if you needed care yesterday, you have different buckets of money, cash accounts, emergency fund, CDs, savings, retirement accounts, brokerage accounts. You have different buckets of money. Which account are you going to first to convert into cash flow and pay those bills on a monthly basis? Now, it was very important, and I said, if you needed care yesterday, the reason that's so important is whoever speaks up is probably the one handling the finances. I don't care if it's the man or the woman. Whoever speaks up, I'll probably go to the cash. I'll stop and say, no, wait a minute. You're the one that needs care. You can't make this decision. And I'll turn to the spouse and ask him, now, which bucket of money are you going to? And they'll realize that if there isn't a plan in place and they're having to make this decision at a time of crisis, it may be the person that's normally making that decision that is unable to make that decision at that time. That's one of the reasons, and you want to have a plan in place. Now I'll allow the spouse that's making decisions to answer. So which is it though? You would go to the cat. You'd want her to go to the cash accounts first. Okay. So you have some CDs, some money market funds. How much do you have there? About $200,000. Okay, by the time you're age 80, that's going to cover maybe a little more than 1 year of care. Very important to do this now. If that $200,000 didn't exist, what does that mean to your healthy spouse who's trying to maintain a retirement lifestyle? Probably say, oh, that's okay. We don't rely on that for income. Okay. Now that that 200,000 is gone, what's the next bucket of money you're moving to? Oh, we'll probably move to retirement accounts. Okay. And what do you have as far as retirement accounts? How long will that last you? The same exercise. You can click on each one of these or scan each one of these QR codes with your phone, and it's going to play a short video and talk about the consequences of converting these assets to create cash flow for long-term care. For example, if they're taking money out of their retirement accounts, well, first of all, who knows how much they're paying for Social Security? Taxes on their Social Security right now can be 0%, 50%, or 85%, depending on how much taxable income they have. So not only what they're taking out of the retirement account is it taxable, it also increases the provisional income, which can increase the taxes on their Social Security. And again, depending on how much they're having to take out and how high their income is, it may increase their Medicare premium surcharges or IRMA tax, and subject them to the net investment income tax. So my point is, in retirement, when you have to increase your spending and convert assets to cash flow, that can have a significant effect even above just having to pay taxes on those withdrawals. Now, what we want to talk about today is an asset-based long-term care plan. And when I use the term asset-based long-term care, it's one of two types of plans, either an annuity-based plan or a life insurance-based plan. And it doesn't matter which it is, basically they work the same way. You're going to have a base policy, a base annuity with an account value, or a base life insurance policy with a death benefit. And if we're going to reposition a portion of your assets, and when I say reposition a portion of your assets, that can be done on a single premium or that can be done on a monthly premium to your age 100. But you're going to reposition a portion of your assets. Maybe it's $100,000 of that emergency fund that you mentioned. By the way, we have plans that stay completely liquid, you'll see. Um, Maybe you move that $100,000. And if you need care, yes, we're going to spend your $100,000 first. But what they all have in common is an extended tax-free long-term care benefit. So once your $100,000 is gone, the policy is going to keep paying the claim, so you don't have to move on to those IRAs or those other assets that your spouse may be relying on for income. We also talk about, again, the idea of planning, the income tax advantages. You can watch any one of these videos you want. Now you can scan over and say, here's the advantage of reallocating cash into a plan like this, or a retirement account, or reallocating a non-qualified annuity, or retirement income. We have a lot of people that are mad they have to start taking out their RMDs. Well, let's take that income and pay an annual long-term care benefit for it, or you're reallocating employment income. So again, there's not a right or wrong way to fund it. Now, remember early on, I said long-term care planning is all about creating leverage. Well, it's not your money that's creating leverage, it's your health. So we want to collect your health information. And here is why that is so important. We have annuity-based plans that are guaranteed issue. Depending upon their age, though, it might turn 100,000 into 140,000 for long-term care. Then that continues to grow inside that annuity, and when they need it for long-term care, it all comes out income tax-free. And that can look like a great plan for someone that is uninsurable. All right. We also have plans that will turn 100,000 into 300,000 right away, or turn 100,000 into a lifetime long-term care benefit, again, depending upon their age and health. If I don't know what their health is and I show them a plan where we're turning 100,000 into a lifetime long-term care benefit, and we find out that they're uninsurable, and all of a sudden now we have to pivot to a plan that turns 100,000 into 140,000 and continues to grow and all comes out income tax free, it still looks like a terrible plan. So we want to make sure we're starting with plans that they can reasonably qualify for. Once you fill that form out, you get it back to me, and I prepare this long-term care planning summary that I call it. And I send you three versions of this. One where we're targeting 100% of their monthly expense at projected expense at age 80, one where we're targeting 75, and one where we're targeting 50%. I personally am not a big believer in insuring 100% of the risk. Doesn't mean some clients don't do it, but I believe everyone can afford to self-fund some of their care. I know if I needed care, I'm not on my boat anymore, I'm not golfing anymore, I'm not eating out, I'm not going on trips. In other words, there's a certain amount of my retirement cash flow I can direct towards my care without risk of impoverishing my healthy spouse who still wants to continue a healthy retirement lifestyle. Now, imagine in the old days, what we had to do is we came with illustrations, showed all the numbers, showed what all the expenses were. Now, what we're presenting is this long-term care planning summary, and we're summarizing some of the different plans. Um, my experience has been most females, the wives, want long-term care. They're the planners, they're seeing friends, or they're hearing stories of wives having to take care of husbands, it's breaking the bank, all of a sudden their lifestyle's changing, and husbands are coming along kicking and screaming. That's another reason we put together this long-term care planning summary, because as we leave this with them, rather than just illustrations and what the cost is, we've embedded in here different videos to help establish the need. And here's what I mean by that. For example, this one on spouses, it talks about the burden a spouse has when they have to start taking care of their parents. I'm going to go ahead and play this video about the spouses just so you can see the quality of the video. Unfortunately, the way we do it through this net meeting, it's on my speakers and in my microphone, so it doesn't sound great, but we're going to send everyone samples of the long-term care planning guide, the whole toolkit, so you can play the videos on your own. But take a look at this video. Oh, went too fast. Sorry about that. All right. Not wanting to start for me here. Let's go. Well, try it one more time. Let's try it one more time. Not. Well, you'll be able to, when I send the samples, you'll be able to click on these and play the videos. This one talks about retirement income and, wife with the assets being spent down, and she doesn't know how she's going to continue to live. So it's pulling on those emotional heartstrings, giving the wife the fodder and information she needs to encourage the husband so they can see, yes, long-term care planning, we're going to have to move some assets around. But if we don't do it, here's what we risk. Adult children, it talks about a daughter. It's from a daughter's point of view on what it means to provide care for the parents, take care of her own children, still trying to keep a job. Family dynamics. I can't tell you how many times I've seen families ripped apart because maybe they have three or four kids and care doesn't always fall equally on all three or four kids. Maybe only two of them are local and one's the daughter, and the daughter's providing all the care. And, it rips families apart for it with it. Um, we also talk about life expectancy because many times you'll talk to someone, well, my parents didn't need care. They're 65, 70 years old. And I find out their parents passed away in their 50s. They didn't live long enough to need care. Cognitive issues and how increasing life expectancy and increasing ages has led to more and more cognitive issues. Of course, a video on the likelihood of needing care. Now, what we also touch on, because we need to, it's very important, is the consequences consequences of converting assets to cash flow. In other words, the consequences of self-funding care. Now we get into part of the planning. And whatever metropolitan statistical area your client thinks they're going to retire in and probably receive care in, and that's one of the questions on that questionnaire, we take the cost of care in that area, which this client was Northport, Bradenton, Sarasota. The blended cost of care in 2025 was $7,550. This was for a married couple, both age 60. Just to let you know. We project that out 20 years, compounded at 3% to their joint equal age of 80, and that's $13,636 per month for care. And that's just the average of moving through informal home health care, assisted living, and nursing home. Now, when I send these to you, I send one set where we're covering 100%. So you'll see in this one, the monthly benefits that we get to at age 80 are $13,636. I also send you a set where we're meeting 75% of that number and 50% of that number. Now, the first thing we want to do is really drive home how long-term care is a cash flow problem, not an asset problem. The clients told me once they go through their cash assets, the next way they're going to fund long-term care is out of their tax-qualified plans. Well, if they have to spend $13,636 a month down at the bottom, they're actually going to have to liquidate $19,480, pay $5,844 of income taxes to the federal government to net out $13,636. And again, that's not taking into account possibly higher Social Security taxes, higher Medicare premium surcharges with Thurman, maybe the net investment income tax is just taking in the very basic. If they happen to have non-qualified capitally appreciated assets, they're just going to have to pay the capital gains tax. So now we're only liquidating $16,042 a month. They said they were going to start with cash assets, so we are going to have to liquidate that $13,636. In other words, dollar for dollar. You've already paid taxes on those. The idea of a long-term care plan is to get up to a 75% discount to create that $13,636. And the first plan we're going to show them is a fully liquid option. This is One America's asset care plan with the return of premium rider. So technically what this is, it's a joint and survivor whole life policy that has a return of premium benefit so they can cash it in and get all their money back at any time, and has a long-term care benefit. So what does this look like? Well, for $220,697 of premium. Now, this isn't money they're spending because they can get it back at any time. I said it's like moving that $220,000 from your left pocket at the bank in CDs to your right pocket into this asset-based long-term care plan. Now, there is a cost. There's an opportunity cost. If you're not going to be earning interest on this, but at any time, you can cash this in and get your $220,697 back. If they cash it into the first year, there's a full chargeback on commission. The second year, it's 50% chargeback. By the way, the commission on that fully liquid option is 8% on that single premium. But what does it cover? If you don't need it for long-term care and you pass away, there's a $327,000 second to die death benefit. So that's if they cash it in, they get every nickel back. If they hold the plan for what it's supposed to do, the minimum they're going to get back is $327,000. Neither one of them needs long-term care. Remember, for a married couple, there's only a 9% chance neither one of them will need long-term care. And there's the full $327,000 that goes on to their beneficiaries. Maybe they have a short long-term care claim and they spend $100,000 on long-term care, then the remaining $227,000 goes on to their beneficiaries. But this is covering 100% of the projected cost. The monthly benefit is $13,636. That's the cost of care that we calculated out to their age 80. And that is per person. So if they're on claim at the same time, they're going to get north of $27,000 per month. And it does provide a combined total long-term care benefit of $981,000. Now, that is a combined joint benefit. So the best way I explain this to the client is the husband has $13,636 a month in benefits that he can pull out. The wife has the same. but you're pulling against the same joint checking account, for lack of a better term, that has $981,000 in it. If just one person is on claim, that would last for 6 years. All right. If you were pulling that out of your tax qualified plans, like you were talking about, and we needed to fund $981,000 of long term care expenses, you'd actually have to liquidate $1.4 million out of your tax qualified plans, pay a $420,000 in taxes to net out $981,000. If it was non-qualified assets that were capitally appreciated, it's only 1.1 million. Of course, if it's cash assets, it's 981,000. We're doing this for $220,000. Now, of course, the 50%, all the numbers are cut in half. Every single number is cut in half. But this is what we're talking about, trying to get a 75% discount. The fully liquid option keeps their mind open. That makes them realize this is an asset. I'm not spending this money. I'm moving it from my left pocket to the right pocket. The next option we show them is what the maximum monthly leverage is. And the reason I say that, this is Nationwide's Care Matters Together product. So again, it's a joint and survivor life policy. They're both covered on the same policy. With this one, we have different premium options. They can pay $233,000 in single premium. So yes, the premium is about $10,000 more than the fully liquid option. But look, you'll see instead of having $980,000 in benefit, we have 1.4 million. But they can also do a 5-pay premium, a 10-pay, a 20-pay, a pay to age 100. Maybe if they did a 10-pay premium at age 55, they could pay it for 10 years while they're still working. And by 65, it's paid off. The policy's paid up, and they've got the benefits. Now, you can't cash it in and get all your money back at any time. On the 233,000, if they decide to cash it in the first year, they get roughly 40% of their money back. But what they start to realize is they're never going to cash these policies in. But for long-term care, they're not going to need these funds to fund their retirement. It goes on to their children if they pass away and don't need care. But if they do need care, this particular plan, Nationwide, their inflation rider makes a lot of sense. So we start off with the $7,550 a month per person. That's compounded at 3% annually, and it goes up to $13,636 by their joint age 80. With One America, we can't add an inflation rider with that return of premium, so we just start off with that same 13,636. The difference is, though, while the monthly benefit is the same, for an additional $10,000 in premium, instead of getting a $981,000 pool of money or quote joint checking account, we have $1,455,000, which would actually cover someone for 8 years. But again, it's whichever spouse gets to it first. And if they don't need it for long-term care, there's a $271,000 death benefit that goes on to their children, a second to die death benefit. So what does that mean as far as the tax qualified funds? You know, if they were pulling and they wanted to get that $1,455,000 out of their IRA to pay for long-term care, they'd actually have to liquidate over $2 million in long-term care, pay over $600,000 in taxes. We're doing this for $233,000. So almost a 90% discount on their dollars. That's what we're talking about in creating premium leverage. Now, a lot of individuals will at this point bring up and say, you know what? That means if my husband uses all 8 years in benefits, I'm left with no coverage. But, you know, even if that happens, you're much better off than going through $2 million of your IRA funds, and now you have no coverage and no income, right? And here's something else to think about. The real risk for long-term care to have a catastrophic effect on retirement is when you're married, the first spouse, usually the husband, needs care, and he has a healthy wife trying to maintain a healthy retirement lifestyle that's going to outlive him, because we can't redirect all of the cash flow towards his care. We can redirect some of it. He's not golfing, he's not boating, so there's some cash flow that can be redirected towards his care. Once he's gone and the wife needs care, and we aren't worried about a healthy spouse needing retirement, we can redirect almost all of the cash flow. If she goes into assisted living or independent living, we can liquidate the house and redirect all of that cash flow towards her care. We aren't worried about maintaining a retirement portfolio for a healthy spouse. But we also always show the unlimited lifetime benefit with One America. Again, the premiums are going to be a little higher, 268,000 for the single pay. The pay to 95 is $19,377, on an annual pay to age 95. But they have a monthly benefit of $13,636 and an unlimited lifetime benefit, so they can never exhaust it. And if they don't need it for long-term care, there's a $327,000 death benefit that goes on to their beneficiaries. So, with that said, what we're using this long-term care planning summary on, I can't show, how much you'd have to liquidate out of your qualified plan because this is an unlimited plan. So instead, we show some of the longest claims, 14 years, 19 years, 16 years, and how much someone's received out of these policies. Now, what we do is we use this long-term care planning summary to narrow down what's speaking to them. Do they like that fully liquid option? And I'll tell you, the people I see that like the fully liquid option is usually when the spouse, usually the wife, wants a long-term care plan and the husband does not. He's coming kicking and screaming. And if he has the ability to cash this whole thing in, he wants to maintain that flexibility. The maximum monthly benefit leverage option, I found that this plan with Nationwide works particularly well for younger people when we have an 8-year benefit because their inflation rider is priced so competitively. Or some people want to pay a little bit more for the lifetime benefit. As people get older, the difference between the 8-year benefit with Nationwide and the lifetime benefit with One America becomes narrower and narrower. So first thing we do is narrow down which types of structure, which one of these plans is speaking to you the most. Maybe they say, you know what, I really like the asset based, or I'm sorry, the Nationwide one. Okay, how do we want to fund it? Do we want to do a single pay, a 5 pay, a 10 pay, a 20 pay, a pay to age 100? Well, I'd like to see a 10 pay and maybe a pay to age 100. And how much monthly benefit do you want to cover? Is it 100%, 75%, 50%, somewhere in between? What ends up happening is most people, come back and say, well, can you show me what $10,000 a year in premium would do? Or, for a 10 pay or 5,000 on a pay to age 100, or but can you show me what a $5,000 a month benefit is? In other words, we're going to narrow it down and now we can come back with just the one or two illustrations that they're most interested in. But we also have a lot of one piecers, that have just developed over time and need. For example, for that individual that doesn't understand the difference between Medicare, Medicaid, and who pays for long-term care. And the common thread in all of these is we've got that video with the QR code or that they can click on. And we brand these for you as well. We have one that talks about the consequences of self-funding long-term care. Whether you're in a state that's considering adding a long-term care tax for people that don't own long-term care, the tax exposure risk. Each video goes into more detail. If you liquidate capitally appreciated assets to pay for your care and you pay for capital gains tax, that's a tax that can be completely avoided because of the step up in basis if you pass that asset on to your children. What if you needed long-term care in 2008 when the markets were down and you're having to liquidate your portfolio to generate that additional cash flow? Now you don't own those assets when the market recovers. That's, of course, sequence of return risk. The chances to leverage business income. We can set these plans up so 70+% of the premium is tax deductible to the business. And this is the best part. The death benefit and the long-term care benefit stay income tax free. So even though we're deducting the money going in, the benefits stay income tax free. And they may have trust assets that we can use as a long-term care plan. Now, what does that do? Not only does it reimburse the trust, which may be outside of their estate, it allows them to spend the taxable estate on their care. So right before passing, they can have rapid expenses to help lower their estate taxes and have those funds reimbursed outside of their estate inside their possibly irrevocable life insurance trust. This is one for annuity producers that you should absolutely pay attention to. Let's say you sold a non-qualified annuity to someone, they put $100,000 in, it's grown to $200,000 over time. Great annuity. Problem is the last in, first out taxation. Of course, the first 100,000 they take out is taxable to them as ordinary income. Then when they get down to the cost basis, that's returned income tax free. It's a type of client that doesn't, they're never going to touch it. They don't want the taxes. They're going to pass that on to their beneficiaries along with the deferred tax liability. The type of client that's mad they have to take out their required minimum distribution because it increases their taxes. Well, let's take what's basically become this dormant legacy asset and leverage it for long-term care and some tax advantages. We can 1035 that into a plan compliant with the Pension Protection Act. And there are plans out there that are joint policies. We can cover husband and wife. They do have to be married only because to do spousal continuation and annuity in the IRS guidelines, you have to be married. But we can 1035 exchange that. I don't care how the existing annuity is owned. If it's in the husband's name, the wife's name, or it's jointly, we can get it into this other policy. Let's assume the husband's the owner and the annuitant of the original annuity. We 1035 exchange it over to make it a like-kind exchange. The husband is the owner and annuitant of the new annuity compliant with the Pension Protection Act, but he's also the insured and the wife is the additional insured. It's still a like to like exchange. The wife is still covered for the long-term care benefits immediately. The wife is 100% beneficiary with spousal continuation rights and can continue that annuity. Now, what happens if they need long-term care? Forget everything you know about typical annuity taxation. Because this annuity is compliant with the Pension Protection Act, and if the money comes out for long-term care, it's going to return the original cost basis first, income tax free. And the easiest way to remember this is the Pension Protection Act and the advantage is there to help your clients, not their beneficiaries, not their children. And the government's hoping you spend $100,000 on your care, you get that cost basis out first, income tax free, and you pass the deferred tax liability onto your children. And when they inherit the annuity, they'll have to pay taxes on it. But if they still need long-term care once the cost basis is gone, the tax deferred growth also comes out income tax free. And then once their annuity is gone and it has no longer account value, in this case, it's going to pay another $400,000 out income tax free for long-term care. So we're essentially tripling the value for long-term care. And by the way, on $200,000 or more, this particular annuity is currently crediting 6% interest. There is a rider fee in there, and it depends on how old the individuals are that are covered. Under 200,000 is crediting 5.5% interest. So in most states, when we have that growth, it also grows the extended long-term care benefit. Tremendous vehicle for individuals that have a non-qualified annuity that they don't need to fund their retirement lifestyle. In fact, why would you want to liquidate any other asset for long-term care? Cash that passes tax-free to your kids, capitally appreciated assets that have a step up in basis and pass tax-free to the kids, and pass on a deferred tax liability in the annuity. Let's position that annuity so if we don't need long-term care, it still passes on to the kids, earns interest along the way. If we do need it for long-term care, we can access it income tax-free. Businesses, if it's a pass-through entity, an S corporation, partnership, LLC that elected S corporation, this is where we can deduct about 75% of the premium. So if you're in your 60s, we can deduct 2025 $4,810 per person. So for a husband and wife, it's north of 9,000. Goes up a little higher next year. That's an above the line tax deduction as self-employed health insurance. The benefits stay income tax free. And if you do run into a C corporation, I had a plan we put together a couple of years ago for an individual who owned a C corporation down south of here. His three children were working in that C corporation. The individual that owned it was in his mid 80s, and his wife was receiving round-the-clock home health care with Alzheimer's disease. Now, he can afford it, but he sees the cost of it, and he wanted to purchase policies for his three children that work in the business. So we did a $200,000 single premium for each child, a total of $600,000 going into the policies. We got a tax deduction for $500,000 for the corporation that year, the C Corp. The kids own the policy, so $100,000 combined between the three of them in income was taxable income to them. And that keeps all the long-term care benefits and death benefits income tax free. And by the way, in those policies, within 5 years, after 5 years, the plans become completely liquid. They could cash it in and get the entire $600,000 back if they wanted to. We have something called our assisted long-term care sales process. I call it field training. I want to get everyone up to speed on this. I'm never going to expect you to, go through plan designs, know what's the best for your client. You get that questionnaire over to us. We'll go through the annuities, the life insurance plans, put plans together that make the most sense for your client, which products, depending upon their age and their health, it's different plans. I'm always going to do that for you. I'll get on the phone with you, do a quick Zoom meeting, coach you up on the presentation so you can make it to your client. But for your first two meetings, you can position me as the prophet from afar. In other words, your back office long-term care planning specialist. And with you there, either with your client in person or on the Zoom call, I will take the lead every step of the meeting, every meeting along the way, no split in compensation at all. It's really to get you up to speed. What we're doing is not rocket science, but we want you to see how the process works. After the first two meetings, if you want to do that, we have some advisors that want to do that. If you're on the meeting if you're in every meeting every step of the way, I know we're going to have a better chance of being successful because you're the one that has a relationship with the client. Plus, they're looking to you for any service work. There would have to be a 70% to you, 30% to MRW split in commission. There are some advisors, P&C advisors, money managers that say, I don't want to deal with it, but I want to know my client's taken care of. And they'll just send me the name and contact information for their client, and I'll reach out to the client, keep you advised every step of the way. But in that case, it's going to have to be a 50-50 split. My real goal is to get you up to speed. If you're used to selling annuities and you're an advisor, there's no reason you shouldn't be up to speed after just the first two meetings. So our goal is to make you self-sufficient in this. I'm always happy to jump on a meeting. Let's say you got a C corporation and you've gotten it to that point, but now we've got the CFO, their CPA, and the owner of the business on, and they want to know exactly how that tax deduction works. I'm happy to jump on those meetings at any time where someone's getting in the weeds. No split in compensation for that ever. There's only going to be a split after the first two if I'm there every step of the way in every meeting helping out. Once again, my name is Tom Vassallo with MRW Financial Brokerage. Thank you for taking the time to watch this. Down below, there is a link to my calendar. Book a time so we can get you started in the new year with our long-term care planning toolkit for annuities. Thank you very much and have a great day.